Hedging risk reversals example. Now this example is used by all the hedge funds, mutual funds, high net worth client. Because if you listen to news, you will hear that hedging is the most popular method. And it is. Now let's say you already own 500 Microsoft shares and want to hedge your risk. Now you will write and sell covered call plus protective put, which will hedge your position. So you will write the MSFT October $42 call at $1.30 and buy MSFT October $40 put at $1.40. So now you will be paid 10 cents as premium. That is, you paid $1.40 for buying the put and you earned $1.30 through the call option that you wrote. So in the end, you had to pay $10 from your pocket as premium. Usually the people in hedge fund industry like to put this strategy when both these premiums are equal so that they don't lose money. It's a transaction that is of equal value. No problem at all. However, you can even use this thing, although it's a loss, but it's something to apply to remove the risk. It's for hedging, right? So if you want to hedge, then if you have to pay something, it's not that bad, because basically you're removing your risk, which could be far more damaging than this 10 cents. You will buy 5 put and 5 call options. Now, if you remember, in our bull risk reversal strategy, we put in 10 put and call option. Now you might be thinking why we are putting 5 put and 5 call option. The reason is our shares. We have 500 shares, and if you remember, one call option. So one option is equal to 100 shares, and therefore 5 options would mean 500 shares. And 5 puts means you are putting it for 500 shares, and 5 calls means you are putting it for 500 shares. Now, if you look at the price, at any given moment it can either go up or down. It cannot do both. So that's why if you put in on each end, we won't have the risk on each end. We would have the risk on one end. We would be claiming one end of the put or call option. That's why we are putting it on both ends, because we would need to use it on only one end. Therefore, a total loss due to the premium paid would come to $50. How? We paid 10 cent premium, multiply by 100 shares, multiply by 5 contracts. So it comes to $50 loss that is initially booked. Now if on expiry, the stock is trading at $42, then the stock will be sold automatically on the call strike price of $42. If the if the stock is trading at 42, 43, 44, 45, our stock will be sold automatically to the call strike price, because he will claim it at 42, and it will be simply sold to that guy who will claim it. As simple as that. Okay? Next. Now in this scenario, we got a good rate to exit the stock. And basically it helped us to hedge the stock. That is, we knew that the max profit that we could make is $42. If at the time of putting in options it was trading at 41, we knew we could make easily $1 profit. However, then the stock is sold, so it's gone. You have no stock left with you and the profit is booked. So it's a simple thing. You buy stock, it has risen from a low to a good profitable position. Then you want to remove the risk, because you know if it falls, it will take away all the profit. So by putting this strategy, you have removed the risk. The stock goes to 42, you sell. Usually people trade this kind of strategy at like major resistance. So they know at 42 get out rather than selling the stock. So now in the second scenario, let's assume MSFT ended in between $40 and $42. The options contract, that is the call and put options contract that we put in on expiry date. So it's trading, let's presume 41, 42 or 40. Now in this scenario, the put and call will both expire worthless. However, your initial loss of $50 will stick. So that is the initial loss. Now, once you're hedging, this is the minimum price that you need to pay for hedging. Now, why would you hedge? You would hedge it for, let's presume, an earning report is coming or any other major report is coming, and you have a risk that it can suddenly plunge down. So you put in this scenario, this hedging risk reversal example. Now, if after the earning report or that news, the stock doesn't fall, it stays within that band that you have put in through the put and calls options. So in this scenario, you get to keep your shares and that $50 loss initially booked. But basically what happened is that report came, but it didn't fall, so it gave you a sigh of relief. Okay, the stock is not that bad, or that earning report was not that bad. So this hedging like risk reversal example usually come into play when you have a risk in an announcement or something related to it. Example, oil falls. So you assume that your stock, which is related to the oil industry, could take a dip as well. So you can put in this risk reversal strategy. Now in the third scenario, MSFT ends at $35 or below. Let's presume the earning announcement comes, or the oil fall that you predicted earlier could affect your share, and it does affect your share. Your share suddenly falls and goes to 35. In this case, the call option that we put it on the top will expire worthless. But the $40 put op position that we put it on the lower level as a floor will help us to sell out our stock. Although the price is at 35, but we will be selling at $40. This is the hedging risk reversal example. That although the stock could go lower to 0, but you have that put option and you can claim it on any day you like. That is the American options. Therefore, you will end up saving all the loss below $40 without any problem. So basically the hedging risk reversal trade comes into play usually when you are predicting like fall or something and you want to remove the risk. You are predicting a news to come in and the news could be wrong, could be really bad, and the stock can plunge down. So in that bad news, if you want to stick to the stock, you can put this hedging risk reversal trade, which will help you in getting the stock with you if the news is not that bad. But if it is bad, you can simply sell it. So it's like far better for you to use the hedging risk reversal example than simply holding on to your stock, because if it falls, then it can go to 0. And in a second scenario, it can simply open lower, $5-10 lower. And if you look at the market, this usually happens a lot. So this hedging risk reversal strategy removes all those risks, and that's why it is most popular among hedge funds, mutual funds, and high net worth clients. Thank you.